Hello friends, in this video we will learn about what is the corporate action. So let's see whole video. You will get all the information related to the corporate actions. Corporate actions are actions taken by a company that impact the shareholders' values directly. It is an event that brings material changes to the company and affects its stakeholders. Corporate actions are the actions taken by the company and it's directly impacted on shareholders. Let's see types of corporate actions. So these are divided into two types. First is mandatory corporate action and second one is voluntary corporate action. So let's see one by one what is mandatory corporate actions. These actions are initiated by the board of director of the company. Through these actions have an effect on the entire company. The shareholders have a little say in the decision making process and they generally have to accede to the decision taken. Its simple meaning is these decisions are taken by board of director of the company and its effect on whole company and shareholder have right to keep opinion or help in taking decision whatever top management are taking decision related to the companies. So shareholder have some right, so they are also giving their own ideas and thoughts about that particular things. For example, dividend. Everyone know what is the dividend? If you don't know, I will explain in next slides. So please watch this video end. Second is stock split, reverse stock splits, buyback, bonus issues and spin off. These are the example of mandatory corporate actions. I will explain in more detail in next slide. So just wait for a minute. Second is voluntary corporate actions. These are actions where shareholders can participate. Any voluntary corporate actions requires active participation from its shareholders. Whenever a corporate taking any actions, they need to participate actively all shareholders in that decision, like a tender offer, right issues. These are the example of voluntary corporate actions. So what is dividend? I want to explain simple meaning of dividend. Whenever any shareholders buy preference shares or ordinary shares of any company, so company need to pay dividend. Dividend is like interest. Okay, I hope you get what is the meaning of the dividend. It is a fixed by some percentage and after completing 1 year company gives dividends to preference shareholders or ordinary shareholders. So first point is this corporate action decided during the annual general meeting. Every year companies held annual general meeting. In that meeting they decide what we gives dividend. what is the percentage of the dividend we are giving to our shareholders. Companies shares their profits with the shareholders through the dividend payments, which are either a percentage of shares face values or quoted as a value per shares. And dividend is depend on the company's profit. When company's profit is more, you will get more dividend, and if company is not uh, earning more profit, they are not giving more dividend. So it's totally depend on company's profits. It is not a mandatory for the companies to pay the dividend each year. If company is not performing very well, so obviously they have not good profit, and that's why they are not paying. Sometimes they are not paid in dividend to their shareholders, and these could be paid either out of the profit or the cash reserves. For instance, if the face value of the company shares is 10 rupees and it declares a dividend of rupees 20 rupees per shares, then the dividend is 200%. I hope you will get what is the dividend. So let's see. Next is stock splits. What is the stock split? When any person have stock of particular company and company decide to split their stocks. So if one person have 10 shares of any particular company and company is split their stocks, so that person got more stocks. Let's see more information from this point. Any company increases the number of the shares that are outstanding by issuing more shares to existing shareholders. For example, in a 2 for 1 stock split, if I have 2 stocks and company decided to stock split 2 by 1, we can see buy 2 get 1 free. Same like that, every shareholder holding 1 share is given an additional shares. In such a cases, the face value of the shares is reduced. For example, say from 10 rupees to 5 per shares. Company's stock price is also affected by the stock splits. After a split, the stock price of the company is reduced since the number of outstanding shares increases. However, the market capitalization remains the same. Whenever any company decide to stock splits, their market capitalization remain the same, but prices reduce. You can see examples from this table. These are the companies and old face value and new face value. Old face value is 10 rupees, and now after stock splitting, the new face value is 1 rupees, 2 rupees, 5 rupees, and 2 rupees. And this is the recent example. Now we are learn reverse stock split. What is the reverse stock splits? A reverse stock split is the measure taken by a public companies to reduce its number of the outstanding shares in the market. Existing shares are consolidated into the fewer shares, and this result in the higher stock price of the stock shares, but has no immediate effect on the total value of the stocks to the investors or the market capitalization of the stocks. Reverse stock split, it means if any company have 100 shares and they want to reverse stock split, so they converted their number of the shares into the 50. We can see the example. First is 100 shares, company have 100 shares and they are converted into 50 shares and their market price is 10 rupees, and after reverse stock split new market price is 20 rupees dollar and their market cap is $1000 and market cap is new after splitting is same $1000. So after reverse stock splitting their market capitalization remain the same. There is no immediate any effect on total value of the stocks, but yeah, number of the stocks shares are reduces. Now let's see shares buyback. What is the shares buyback? In buyback, the issuing companies repurchase the outstanding shares from the market, thereby reducing the liquidity of the stocks. It is the management strategy to either increases the value of the shares or to eliminate any threats by shareholders who may be looking for the controlling stakes. For example, any company have thousands of shares they are issuing and all public investors buying that shares. Company feel threat from any shareholders because some shareholders are trying to buy more and more shares and they are want to be a 50% of the owner of that company. That situation, company buy back shares. They are using this strategy for eliminating risk. So next topic is bonus issues. What is the bonus issues? A bonus issues is a stock split in which a company issues new shares without charges in order to bring its issued capital in line with its capital employed. And this usually happens after the company has retained profit, thus increasing its employed capital. Therefore, bonus issues can be seen as alternative to dividends. No new funds are raised with the bonus issues. Bonus issues are provided to the shareholder which is already existing and they try to make good relation with our shareholders and that's why they are issuing bonus shares. What is a spin-off? Spin-off occurs when existing publicly traded companies sells a part of its assets or distribute new shares in order to create a newly independent company. If any company want to create a new independent company, that time company use spin-off strategy to stay connected with their shareholders. Often, the new shares will be offered to the right issues to existing shareholders before they are offered to new investors. The investors already existing in that company, they are offered to new investors. Depending on the situations, spin-off could be indicative of the companies ready to take a new challenge or one that restructuring the refocusing the activity of the main businesses. After doing spin-off, company try to restructure and refocusing on the main business of the company. What is the merger? Merger is the very big concept of the finance terms or any organizations. A merger is the business deal where two existing independent company combine to form a new singular legal entities. Merger are voluntary. Typically, both company are similar size, scopes, and both stand to gain from the transactions. Merger happen for variety of the reason. They could allow each company to enter a new market, sell a new product, offer a new services. They can also reduce the operational cost, improve management, change their pricing model, or lower tax liability. Ultimately, however, the company must to increase size, skills, revenue. In other words, merger helps company to make more profit, make more money, and that's why companies uses merger concept. This is the last topic of this video, tender offer. What is tender offer? The tender offer is the public open offer by acquire to all stakeholders of the publicly traded corporation to tender their stocks for sale at a specific price during a specified time. In tender offer, the bidder contacts shareholder directly, inviting them to sell their shares at the offer price. Tender offer is the corporate finance term denoting the type of the takeover's bid to induce the shareholders of the target company to sell, and the acquired offer price usually include the premium over the current market price of the target company shares. Next topic is right issues. A security giving stockholders entitlement to purchase new shares issued by the corporations at the predetermined price, normally less than the current market price, and the entitlement is in the proportion to the number of the shares already owned. Rights are issued only for the short period of the time after which they expire. Thank you so much for watching this video. I hope you like this video, and please share with your friends, families, and what who need these videos. Thank you so much. Keep supporting. I'm always helping with the help with you. Whatever point, whatever topic you want to, I make that videos. Please comment on the comment section. I will make my next video on that topic.